Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup for the trading week ending March 7th, 2025. I'm Preston Britton. Thanks for tuning in. Well, the theme this week continues from last week. Volatility still up, equities are down, and risk is off in the markets. Let's take a look at where we're going and what it looks like to me, at least for the near term, and where we can go. If you look at this past week, everybody was in the red. Dow, S&P, NASDAQ, Russell. The only one in the green year to date is the Dow, just barely holding on 61 basis points to the positive side. The Russell is the worst at 7% down, NASDAQ a little over 5.5%, S&P about 1.9%. I think we're seeing a lot of ongoing uncertainty around trade policy. It's kind of the focal point this week. The Trump administration's announced a slew of exemptions and delays for tariffs later this week, including announced that goods covered by U.S Mexico-Canada Agreement would be exempt for 1 month. However, there's just a lot of uncertainty and changing policy, so that's why we're going to always see the VIX bid up. The market's a little bit nervous about that, and it's just we're getting these wide trading ranges during the day. Okay. In fact, we had a very busy economic calendar this past week. On Monday, the PMI came in, showed activity expanded just a little bit in February with a reading of 50.3, so slightly in expansion territory, but just barely, okay? But it's coming down because in January it's about 60 basis points higher, okay? New orders also registered a sharp drop, falling to 48.6 from 55.1 in the prior month. So that does suggest that manufacturing PMI is pulling back just a little bit. Meanwhile, in the services PMI, it increased 70 basis points to 53.5, the 8th consecutive month of expansion. Remember, expansion's anything over 50. So we did see that, and it increased 1.6 percentage points from the prior meeting, the prior month rather. And then we've got the Fed Beige book, which rose slightly mid-January. We're seeing the economy still healthy but slowing down. Consumer spending was also lower. There's more sensitivity to price increases. So we're seeing that in the Fed Beige book. And then finally, at the end of the week, we got nonfarm payrolls. It came in at about 151,000 in February. That's slightly below expectations, but not by much. But January's reading was 125, so it's a little bit stronger than January. And the unemployment ticked up 4.1%. Okay, you can see the PE ratio in my mind is still very rich. The forward 12-month is 21.15, which is down 9.5% from the prior 12 months. But I still think it should be a lot lower than 21, probably in the low 20s or high 19s is where we should see it. That would suggest we're still overvalued just a little bit. The 10-year Treasury came in at 4.305. The dividend yield 1.33. The earnings yield for the S&P is still 4.61. Okay, so the yield of the S&P over the 10 years is only 30 basis points. All right, that's like 1/3%. So that still attracts money to the Treasury market. The real yield, if you factor in inflation, is about 1.61%. But look at the VIX, guys. It was up again 3 weeks in a row. It was up 7.8%. This Friday's close, it came in at 23.37. The prior week's close was 19.63. So we're moving in the wrong direction for volatility, but that's due to all the policy changes and just a little bit of confusion from the market's perspective on the tariff situation, the trade policy coming out of the Trump administration. Okay. Then we can see the best and worst performers for the week. Healthcare was strong, not only weekly, but year to date is very strong. It's up over 10.25% year to date, healthcare. And then bringing up the rear for this week, financials took a bath, 2.79. And then year to date, discretionary, which makes sense. That is a risk on. The sector is performing poorly because risk currently right now is sitting in the off switch. If we look across the border or across the ocean, you can see in Europe, mostly in the green. right? The only one that had a down week this past week was the FTSE. But look at it year to date, very strong, leading the U.S. almost like completely opposite of the past couple of years. This is like a dead cat bounce because Europe has been lagging for the past decade in the U.S. So a little bit of a bounce here makes sense to me. The ECB also cut their key deposit rate by 25 basis points to 2.5%. Everybody was expecting that. And Queen Bee Lagarde, the ECB president, said that rates are now meaningfully less restrictive. Um, and they're saying that the annualized inflation amount in the Eurozone slowed to 2.4% in January from 2.5. So it's going in the right direction for them. And the core rate fell to 2.6 from 2.7. So it's, even though it's still higher than they would like, because like the Feds here, they'd like it at 2%. It's still coming down, or it's backing off just a little bit, whereas here in the U.S. it's remaining sticky. It's not going up or down. It's just kind of holding solid, right? The other thing that European leaders came out and said is they're all backing plans to jointly borrow about 150 billion euro to spend on their respective militaries. They're going to be spending more money on their military all across Europe, so that'll help the euro, the currency, as well as the economy. Okay. And then, of course, if we go over to the Asian markets, you see the Nikkei was down in the red for the week and for the year. Okay. The yield in the 10-year Japanese government bond is up to a whopping 1.53%. That's real high, guys. The previous week is at 1.37. It's the highest level it's been since 2008. A lot of this expansion is based on a lot of markets believing that the BOJ, the Bank of Japan, is going to continue raising their rates this year. Okay. And this is one that I gave you guys as a freebie. I said, you want to be long the yen, and sure enough, it's taken off. Then finally in China, you can see in the green, both weekly and year to date. China's got different issues than Hang Seng, which is Hong Kong, even though it's part of China. China, basically, they came out of their National People's Congress meeting. It's an annual event that they hold, and they just said that their key targets for next year in GDP are going to be 5%. That's like the third straight year they're leaving at 5%. Most analysts believe it's probably going to come in a little bit less than that. And then the Chinese officials set their deficit goals at about 4% of their GDP. That's the highest level since 1994 for China. Okay. So they're trying to reduce their annual inflation target. And they're also trying to get the consumers to spend more. They're trying to convert from a manufacturing economy to a consumer-driven economy. And there's going to be a lot of setbacks as they do that. Plus, Trump is looking at slapping more tariffs on China. So China's going to have a hard time hitting their growth rate with the trade uncertainty with the U.S. And they're still in their housing slump. They have, a lot of analysts believe they haven't hit bottom yet. So a lot of bad news is going on in China, even though they're just barely in the green year to date. So a lot of this we just have to be very circumspect of. I'm going to shift the screen over real quick and show you some key asset classes. Let me just get over here like this. Here we go. It's going to take a couple of seconds to come up on your screen here. But what we're going to be looking at first is the E-mini S&P 500 futures. It'll take a couple of seconds to come on. Let's just get this set here. Let's see here. Let me switch the screen here for you. Okay, so now I'm showing that you should see it. So what we're looking at here is the E-mini S&P 500 futures. I've got it on a daily chart. So you can see here that we're sitting here off of the, well, this is not the E-minis. Let's get the E-minis on here. This is Nat Gas. Nat Gas is doing good, by the way. We'll talk about that in a minute. Let me just get E-minis. Here we go, right here. You're going to see the E-minis are in the red. You can see the closing price from last year, 2024. We made new lows for the year on Friday, but look at that candle. We had a lot of buyers stepping in this shaded zone here that I have from about 57.75 down to about 5,700. So I'm seeing buyers step in. You can also see this yellow line, which is the 200 EMA, not the simple moving average, but the exponential moving average. You can see literally on the 4th, the 5th, the 6th, and the 7th, right? 4 days we were at or below and then closed above the 200 EMA. That's a good sign. It shows buyers and algos are stepping in as buy opportunities here. You can see how we finished the day here. So now what I want to see is there going to be follow through on Monday? You can see this candle here on the 5th. We came all the way down to the 200 EMA, closed up towards the upper end of the range for the day. And then the very next day, we gave it all back up again. Okay. And then the next day, we got this green candle again. We came all the way down and we came back up towards the end of close. So I want to see if we can get some follow through here. If we look at the volume, you can see volume has picked up during this move lower, right? And then you can see volume is starting to pull back just a little bit as we're starting to find our skis here and find a bottom. So we got to watch this really closely. And if we look at the Dow, which is performing the best, you can see here on the Dow, let me just come back to the MACD. You can see here where these are the Dow futures. We're above the 200 EMA. We're slightly in the red. These are the Dow futures, not the Dow index, right? We moved into the green and then we closed back into the red just slightly for the Dow, right? If we look at the Dow index, not the futures, you can see here we're in the green just a little bit, right? Now these futures are the Q2 futures contract date. So they're looking at June for the futures, but the current index, the cash index, is slightly in the green, just barely. And we're sandwiched between the 50 and the 200 EMA. The S&P E-minis futures are below the 200 EMA. Now let's look at NASDAQ. NASDAQ is ugly. You can see here with NASDAQ, we're below the 200 and we made new lows for the year on March 7th. This is this past Friday. And we didn't get a green candle. So, and we finished up on the day, but still well below the 200 EMA. Okay. So we've got to get up above it. And then you can see both the 50 has got a downward vector to it. But we still got a lot of makeup to do here with the NASDAQ. And then the Russell is the worst. You can see here with the Russell, intraday, we were down 9.62%. That's almost correction territory. Not quite. You can see both the 50 and the 200 have a downward vector, the 50 obviously more. But you can see how far below the 200 EMA we are with the small cap index. Okay. So again, not a good sign. And if we look at the FANG index, this is just a combined index of the FANG stocks. You can see I haven't even marked it yet, but we're well in we had a low on Friday, but we're still in the red year to date for the FANG index, right? And then if we look at the MAG 7, this ETF is a MAG 7. You can see here I got to adjust this too. We also hit new lows on Friday as well on this, but we managed to get back and clear the 200 EMA, but just barely. So net, all the markets are hard down. And when you get this kind of environment, like I've told our members, generally any bull move higher, it's got to be supported by increasing volume. And then you've got to expect a pullback, but that pullback has got to be and make a higher low. If it does not, then we're still in this sell the rally mode. And right now we're still in the sell the rally mode. I mean, that's just kind of where we're sitting right now. And of course, if we look at Bitcoin, you're going to see Bitcoin. It is in the red, but we're sandwiched between the 50 and the 200. Right. So, and with the Bitcoin conference on Friday, didn't really help Bitcoin. You could see it sold off over 3,000 points. Primary reason is because they're looking to see the U.S. buying Bitcoin. Right now, the U.S. is just taking Bitcoin that they've confiscated in illegal transactions and so forth, and use that money or use those Bitcoins to start the reserve Bitcoin currency reserve in the U.S. But I think eventually it's going to start to take, and we're going to see this. Right now, it's going to be a buy the dip opportunity, but I don't believe we're quite there yet. Okay, and you can see this 50 EMA. You can see right here, we literally sat on it for almost 2.5 weeks, right? So that's going to be a key level for us to get above. If we come down here and look at volatility, I'm going to show you guys. Let me just show you the volatility skew. If we look at the front month skew, you can see here, this is comparing the VIX to the March vol expiry. We're still in the red. That is a backwardation. Let's look at the back month skew. If we look at the back month skew, that's comparing March and April volatility futures. We're even more solid in the red, okay? So going out to April, and then if we look at the April-September spread, you're going to see here with that, we're in the red here also. So when you've got all three of these in the red, you got a lot of fear in the markets. And it's very difficult for the markets to hold a mid-20s VIX unless the markets, are in a sell the rally mode, which is what we're in right now. So this week is going to be a real interesting week. We got to see where the markets want to go. And keep in mind, we got this, it can sneak up on you. March 14th, we've got, are they going to shut the government down because they can't agree to a budget or not? And I'm hearing rumors that a shutdown is a higher probability. If that happens, then on Monday or Tuesday the following week, we can end up moving down, right? The last time we had a government shutdown, the market sold off to about 10 to 12% to the downside in the S&P. NASDAQ was down 15%. So we're not quite there yet, but we're down about 5.5 or 6% in NASDAQ, a little over 4.5, almost 5% in the S&P. So we're halfway there. So it's not going to take a lot to push us off the ledge. So you got to trade with a risk-off mindset at this point in time. If you look at treasuries, look at the 10-year interest rate. You can see the 10-year interest rate here. Off of the lows, we've seen we were up here over 4.80 interest, and now we're down to 4.31. So that is not a good thing right now. That means people are buying bonds, and when people buy bonds, that means they're a little bit nervous about the economy. It's like a flight to safety, right, in this particular case. So this just does not vote a lot of confidence in the market as we stand right now. I do believe once the tariffs get sorted out, and once some of the policies become more clear, I think you're going to see the markets have a pretty good little bounce and be an opportunity of some good buys out there on select stocks. But right now, no, it's not there yet. Even if we get this bounce on Monday, it's not there yet. And then, of course, if we look at currencies, look at the euro, very strong move higher. Look at this. I mean, we made new highs for the year. I mean, we just took off. Once we cleared the 50 EMA, remember what I told you guys, if you clear the 50 EMA, it's worth going long the euro and short in the dollar, and we just took off, right? Just a huge move in a very short period of time, okay? And of course, if we look at the U.S. dollar, you can see with the euro that strong, the dollar's going to go in the other direction. And look at this. We made new lows for the year on the U.S. dollar. It's a dollar index, actually. And the euro is about 58% of the dollar index. So generally it goes in the opposite direction of the dollar. But the one I like, the higher probability trade, is the yen. You can see the yen going up right here. Remember, I started getting you guys long, if you took some of my advice, over here with the yen, right? And we had this kind of a poor man's bullish divergence, and it just took off, right? That's big money in the currency market. But I still believe it's going to go up even higher. It'll probably run up into this shaded zone here initially, maybe have a little bit of a pullback, but we're in a buy the dip mode on the Japanese yen. There's no divergences in the MACD as well. So all in all, that looks good. And then, of course, we move over to gold. You can see in this ad class right here, it's going to be chopping around, but it's kind of a buy the dip kind of mode here. I don't think gold is going to move much lower than 2,800. Selling puts in gold futures makes sense to me, or doing flies, broken wing flies in gold futures makes sense to me as well. You can always raise that bar up with adjustments if it runs up, and you can always lower the bar if it starts going lower. Same thing with silver, although silver, notice gold is well north of the 50 EMA and the 200 EMA, well north of both. But if we look at silver, silver is not as strong as gold. You can see silver is pulling back, is further away from the highs. It's still north of the 50 and the 200. Back over here was when I suggested you go long silver and short gold, and the ratio of the two, you would have done very well in a pair trade. All right, I talked about that a while ago. You can see my target for silver is in the middle 30s. I think we're going to get there. All right, I think it's going to chop around more, but eventually we're going to get up in that area. Same thing with gold, right? It's going to chop around, but I do believe over the next 90 days, gold could move higher, okay? And then, of course, we look at energy. With oil, I'm projecting oil to go down to the mid to low 60s. And you can see here, it hit 65.22, but here's my target over here, right? Remember, I've had this target on it, 62.22 in the midpoint, and that's exactly where we're going to go. Or no, let me say it another way. That has given you a higher probability of where oil will go, right? The 50's below the 200 and prices below both. So that tells me that, you know, any rally here is sell the rally in oil. Now, nat gas is a little bit different. It's near highs, right, for the year. Any dip in nat gas can be bought because Trump wants to open up these natural gas terminals in the Gulf of America and then sell them to Asian markets and European markets, right? Europe is still, believe it or not, still buying a lot of natural gas and fuel from Russia. And Trump wants to end that. And I think he'll probably get a sign out from Europe to do that. So we'll see how that shakes itself out. All right, everybody, that's a real quick and dirty on some of the major asset classes as well as the index. Risk is still off. If we do have a rally, look for volume follow up or follow through on volume on the next trading day. We need to hold some of these, and if we make a low, it needs to be a higher low. Otherwise, we got more downside. And then this week, again, March 14th can sneak up on you. The other thing is, over here in the United States, this is daylight savings time, so tonight before you go to bed, turn your clocks forward 1 hour. All right, everybody, have a great weekend. Ciao, folks.